Hello traders, it's ETM Effects and welcome to our Smart Money Super Scalper course. We're going to break this course into two sectors, two different approaches, an aggressive approach and a moderate approach. So let's kick things off with higher time frame. We need higher time frame to figure out which way we're going to trade. We need a slight bias. We need to know where the order flow is. And in this course, we're going to cover 3 ways you can figure out which way you should trade. The first way would be our swing grabs. Second way would be our session order flow. And third would be our RTO bias. So these are 3 ways we can figure out which direction we should trade. And then we can build on our entry system from there. So here we have our swing grab bias, and it's more of an aggressive way of trading. It's more an aggressive approach. Why? Because it's more frequent. You can find 3, 4, 5 ways a day to find a bias, pair. So it's extremely frequent. So what you do is you go on your higher time frame, which would be let's say when you're a scalper, your higher time frame is usually 15 minutes or 1 hour, and pushing it, you could use 45 minutes, you could use an hour and a half. That's really pushing it, right? So what you do is you look at your swings, and each swing. Why did this swing form? Because there's buying power here. Why is there buying power here? Price reacted from somewhere right here that pushed price higher, right? So, and same thing right here. Something pushed price to go higher. So there was buy orders here. Buy orders, somebody bought here. That means there's liquidity present here. So what we're looking for in a swing grabs bias is for price to come down and come back up. So basically come down and come back up, stop hunt these swings. And once price stop hunts these swings, you have your bias right here. Same thing here. Price would stop hunt, come back, bias right here. The reason this is an aggressive approach is because it occurs so frequently. So it's not that you have a definitive swing point where you're like, okay, if this swing point gets broken or stop hunted, now I have my bias. This happens a lot of times throughout the day, especially in a compression market. This could happen 4 times a day, 2 times a session. Like it happens really frequently. That's why I would say this is more of an aggressive approach. This is mostly for somebody that wants to trade multiple times a day. Let's take a deeper look, right? Let me explain this one more time. So you have your swings right here. As these swings, somebody bought here, somebody bought here, somebody bought here. So what you do, you stretch it out. Have the common smart money understanding that there is liquidity present here. So when price comes down here, takes this liquidity, absorbs it, and comes back inside our previous range, you would understand that you have a bias. And we're going to figure out how to get in a trade using this method. We're going to cover this soon, don't worry. But for right now, you need to understand how to present your bias. So price comes down right here, let's say, takes this liquidity, and you have a bias, even if it's for a short period, even if price does reverse here, the fact that you had a bias for a certain amount of time. And what you need to think of in this situation, as price travels, the potency decreases. So you have a high probability of knowing the bias early on after a stop hunt. As price travels a little bit, it can always reverse from a price extreme right here. This will be a price extreme. It can always reverse from the 50% line from our fair pricing. But early stages, you have the edge basically. And that's what you want to focus on. So let's go in a chart example. So to get your direction via purge, first thing you need to do, we would go differently about it than we would go on the higher time frames. On the higher time frames, we would focus strictly on the range, because obviously we would move price from premium to discount and vice versa, internal to external liquidity. But here we're looking at specifically liquidity swings. So first thing you'd want to do is mark up your swings. We have swing here, another swing here, another swing here, and so on, right? And eventually, guys, as you develop as a trader, you won't even need to mark it up. You would be able to just easily eyeball everything and see, okay, price is coming from here, going there, and everything will be a lot easier. But that comes with time, right? So what are we waiting for? We are waiting for price to come to any of these swings and stop hunt it, close above, and then close back below. That would show us the direction. Price could come down here, stop on here, and continue above. And that's how we will identify our order flow, our micro order flow. And this is the 15-minute time frame, by the way. Okay, price came above here and came back down. What does this indicate? That there is liquidity above this FTC, which has failed to close because price never stopped on it. It just wicked above. We're waiting for a complete close below and close above. Price just continues down, breaking all these resistance levels and taking all this liquidity and not deciding to turn around. Okay, what happened here? Price closed below, as you can see. Price closed below and closed back in. So now we know we have a bullish bias. So when do we have a bullish bias? Look at your next swing. There's no more swings here until this higher swing. And before that, you have a internal liquidity level, which would be your order block. So you basically have the bias all the way from here to here. And the bias was in your favor. Liquidity was taken and price reached your danger zone. So that's all it is as far as this method goes. You want to find liquidity swings, which would be any peak swing, and wait for price to take that liquidity out and come back into the pre-existing range. And that's where you establish your lower time frame order flow. Okay, so let's look our return to origin momentum bias. So look at it like this. On a higher time frame, right? You're looking for a stop hunt. Once the stop hunt takes the liquidity, price expands. So when price comes back to this level, this is the origin, right? This is the origin. So a reaction from here would be a return to origin. And once price reacts from this area, you get an expansion. What we're going to do here, we're not going to wait. We're not going to anticipate this reaction. So what I mean is we're not taking a trade off this reaction. We're not saying, okay, price will react here, so we're just going to get in a buy. No, we're going to wait for price to prove itself. Once we start seeing a higher high being made, we see a reaction from this RTO that's forcing this reaction right here to go a little bit up. Now we can establish that, okay, we are in a bullish order flow. And as you can see, this red circle here is our higher time frame. But inside of this higher time frame, which is a few green candles, you're seeing segments of higher highs, higher lows, higher highs, higher lows, or it could be a consolidation and then a higher high. Either way, it's a bullish order flow, right? So let's look at a candle example. So here you have your liquidity, which is your swing. Stop hunt came, took out the stops, came back up, which formed the origin. So when price came back, it returned to origin, RTO, and you seen price expand up. But this is what happened on the lower time frames. Price gave you a swing, came back up. That's a high. That's a higher high. Consolidated for a little bit and made another high and another high and another high. Either way, the order flow was bullish. And we're going to cover how to trade this consolidation here to take advantage of this entire move. But for right now, this is how you want to look at price. You want to wait for that reaction from that return to origin. And once you see signs of strength, which could be two green candles in your favor or a peak being made or anything like that. So let's say this is your RTO right here, and this is your RTO right here, and let's say you go on a lower time frame, you start seeing, let's say one candle, two candle, three candle, it reached your origin level. Now you start seeing two, three green candles came back, rejected from here again. So now you can be like, okay, price is more than likely to continue bullish. So now I know my order flow is bullish. Why? Based on the reaction from the order flow. So let's look at a few chart examples. So another way of getting your order flow would be waiting for a purge and then waiting for RTO and seeing a reaction from RTO. What is RTO? It's return to origin. And why do you need the return to origin? Why can't you just use the purge, like let's say the 15-minute purge, and use it for directional buys, just how we would use a daily purge for directional buys. Well, the thing is, on a lower time frame, price is more aggressive. It fluctuates more. It's more volatile. Candles can move different direction. It can become more unpredictable. So what you would want to do is wait for another confirmation after seeing the purge. As you can see here, the purge occurred. It took the swing from this liquidity. So this liquidity had to be taken. Price comes back in the range for price to form a scale, which would be a resistance level. Then price comes back up and reacts from this level and comes back down. So once you can see the slight rejection from the RTO, you can now say you have your bias from the rejection area all the way to the scale, which would be your last level of support prior to the basically the origin of this entire move. This whole move that pushed price into your RTO was conceived from this scale. Same thing as you can see right here. Price came down, took this liquidity, purged this area, came back up and used the return to origin, came back to an order block or a inefficiency level that's inside of the purge, and that's what the origin would be. Price comes back to the area where this move started, and this would be what you would call a scale. The scale is the move that was initially the reaction from the purge. Then later on, sell orders came in to sell price into your origin to then push price up. So your order flow is from the area of the rejection to the scale. This is where you can say you have your order flow. And this is what I mean by lower time frames. You would need more than just a simple purge to, let's say, have a bias, right? As you can see here, we have a swing, right? We have a fair swing too, which it has almost equal lows. Then price comes down here, takes the liquidity, it comes back. But when it comes back down, when it comes up for a little bit, so you would have a slight bias, but then price would come down and break this area. And why? Because it did not reject from this origin. Price came back down and did not reject from this origin. And you could even go deeper, and I don't want to confuse anybody because this would be an advanced concept. But as you can see, this would be your purge in this situation, right? So this would be your purge, and you can see price reacted from once it broke. Price came back to the origin, but it didn't come to the origin extremes, which would be your inefficiency inside of your origin. So it didn't come down here; it just came inside. By seeing the fact that it came here once, it can kind of give you a clue that price is more than likely to come back and revisit this area. So you could even use this as an entry, because a lot of times when price gets out of the purge and comes back inside and taps it again, then to revisit it again, it's more than likely to revisit a lower level. Why? Because the levels that it got, the orders that it accumulated from here is not enough. So it usually seeks lower. But the fact that it didn't reject from here shows that, okay, you don't have a bias. And this is why I say if you want to have a bias for a short amount of time, like a 15-minute order flow bias, let's say for a few 15-minute candles, which can all accumulate to, let's say, 2 hours. So let's say you have a 2-hour bias, you preferably should use a purge that shows a movement that later on leaves a inefficiency, and you want to see a reaction from the inefficiency. And we're talking about the 15 and the 1 minute time frame, 15 and the 1 hour time frame to have your higher time frame bias for your 1 minute and 5 minute entries. So here we have a purge, right? And this is what I mean by your order flow. So as you can see, your reaction that you received from reaching the purge, which is your RTO. What I mean by your order flow is this area right here, all the way to your scale, which is right here. The scale is what forced the retracement. And if you go on the 1 minute, obviously we're going to cover entries and how to find entries. But once you can see this reaction right here and price made a lower low, you know, okay, now I have a bearish order flow. So now my bias is bearish. And as you can see, a lot of times this happens around New York open or a little bit after New York. So you can see you have your bias all the way from 9:20 all the way to 10:30. So an hour and 10 minutes, you have a bias. This is a 1 hour candle that occurred on the 1 minute. So you would have your bias here, and we'll cover how you can find entries here, which should be fun. But as you can see, this happens frequently on the charts. A purge wouldn't be enough on the lower time frames, in my opinion, if you want to maintain a higher strike rate and consistency. As you can see, the purge occurs right here. Why? Because this liquidity has been taken. Price break structure, comes back and reacts. And it even breaks structure again and comes back again to the origin. So you can have one bias, two biases. And you can see it happens all over the charts. Even if you look at this, you can say this was liquidity, price purged, broke structure, and then it came back right here to the 15-minute inefficiency. And it doesn't even have to break structure a lot of times. It just has to engulf the inefficiency. So as long as it engulfs the order block and comes back into it, you can say, okay, this is a RTO. Same right here. As you can see, the order block got engulfed, price came back, RTO, broke again, came back, second RTO. And you lose efficiency every time you revisit the RTO. That's why I prefer to only use the fresh ones, the only, like newly tapped ones, as your directional bias. But you could use it once or twice. You could revisit it if you would want. If you want to just kind of add a little bit more frequency to your trades, because using the RTO method to find your scalper or order flow, you might be at a 3 or 4 trades per week. And I know a lot of people want to trade 18, 15 times a week. And if that's what you want to do, you could always take the aggressive approach. But my advice, patience. Patience win trophies in trading. So let's go over session order flow. This is quite simple. If your Asian session and then your London session are both bullish, expect bullish order flow in your New York session. What I mean by that, you have your Asian session, which is majority of the time of consolidation. Your London session was above it. That means if you're looking at it from a daily candle perspective, the candle opened right here, dropped down for a wick, and then started up right here. So the fact that the candle already showed its initial direction, you would expect the order flow of your New York session right here to be bullish. And as you can see, you had a bullish order flow. It might not break the entire candle, but the fact that you know in this current session, the order flow is going to be bearish. And you can see it differ when it's a whipsaw day, right? As you can see. So let's look at more examples. So here we have a bearish Asian session, but we have a consolidating London session. What would the New York session be? It would be the opposite direction of the Asian session. Why? Because price went down, consolidated, and is gonna go up. This is a drop base rally. Drop base rally. This way, you could figure out that the fact that London consolidated, New York will more than likely to be the opposite direction. And I'll show you guys something when we go to entries. There's a way you can snipe an easy entry when you know where the New York direction is. So look at here. We have the Asian session bearish. We have the London session bearish, right? And it started right under it. It did not intercept with anything coming back to the Asian session. So what does this indicate? That New York session is gonna be bearish, just like the previous two. Here again, Asian session is bullish and London session is right above it. So the fact that the London session is above the Asian session and not down here indicates that New York session is going to be bullish, and it had a perfect bullish session. Here you have a consolidating. Here you have a consolidating Asian session, but then the London session came inside of it. It consolidated. It did not. It did look. Let's say the Asian session was right here. London session was not under it. It kind of went a little bit under it, but it came back into its space. So knowing that, New York session will be going the opposite direction of Asia, which would be bullish. And here you have a bullish Asian session, then you have a bullish London session, but here you have a reversal, a high of the day reversal, and your session was wrong. So even though you have the directional bias of the session, you still want to make sure, you still want to look to the left and see what price could be reacting of, because this reversal right here, the fact that we had a bullish Asian session and a bullish London session, we should expect a bullish New York session. But the fact that that didn't happen, that insinuates that there was a higher time frame institutional level right here, whether it's an order block, whether it's a gap, whether it's a significant support resistance level or a price extreme that forced price to reverse in this level and the data as consolidation. So you always want to look to the left. So having the bias is only the first step. Having the order flow of the session or of the day or of the period that you're going to trade in is only the start. You still need more information. And let's build on that. So now that we're done with our higher time frame analysis, let's get into our lower time frame entries. And before you proceed, make sure you like, share, and subscribe. And make sure you follow us on Instagram. And if you're looking for more of an insight to the market on a weekly basis, make sure you join our free Telegram. The link is in the description. So let's look into our accumulation stop hunt. So what you have here, you have a range. You have a low right here and a high right here, and price been trapped in this range. The fact that it rejected from the market extremes once and twice confirms that, but it doesn't even have to get to that extent. Let's say this could be a range. So now you have a range. Let's say price consolidates in this range, stays in within this range of this high and this low for a longer amount of time. We can already say that this is a consolidation. So what we look for, obviously on the 1 minute time frame or the 5 minute, you're waiting for a stop hunt to occur, price to come back out, and I'm going to show you guys how to anticipate a higher time frame entry later. I mean, a higher time frame stop hunt and how to get in as early as possible using our shark fin method. But for now, in this specific entry, we're going to wait for a return to origin. So what you're looking for is you had your range. This is your low. This is your high. Price has been stuck in this range for a little while. What happened? Price came back, stop hunted right here, showed a significant reaction. What you want is significant reaction, and most importantly, you want to be in line with your bias. So let's say your bias is bullish right now. You are trading in a bullish bias. So in a bullish bias, you had a bearish stop hunt. That means what? Sellers been trapped. Anybody that tried to sell in this market right here, breaking this resistance, obviously because we had liquidity. This liquidity been grabbed and traders been tricked. A strong reaction formed. Price came back to the origin, reacted, and gave you a strong reaction. And why we're going to use this, even though a lot of times it is a fake return to origin, the benefits of this type of entry is huge, just for the simple fact that you could be risking such a small amount to gain 4 times that, right? 4 times that, if not 5. So the key of scalping is to have a small stop loss and a huge reward, and brush strike rate to the side, because if you want a higher strike rate, you would trade more of a higher time frame and have a wider stop loss and have a smaller risk to reward. But if you want a huge risk to reward, you need to adapt to the scalping way of trading. So again, what happened here, we had the range, like we explained earlier, price been stuck here, stop on the card, price proved the reaction, price came back to your origin, which is your RTO, and price expanded. So this is our divergent method, right? And what we use to gauge divergence here is the TDI. Which one specifically? The one by Jacob Donovan. Settings are default. So how you would use this is you want to look for divergence, but what occurs during a divergence? You're waiting to catch the stop hunt at its peak. So you're not waiting for a candle close, or you're not waiting for a return to origin, because on the 1 minute, this is extremely dangerous. A lot of times it will not work in your favor. So your best odds when being on the 1 minute is to catch the move that you're looking at as early as possible. And the best way to do it is through divergence, right? And how you would do this is, so let's say you have a peak right here. You would wait for the peak not to fully extend. So you would wait for your peak to take this out. As it's taking it out, the divergence is not taking this peak. So as you see, this peak right here is this peak right here. And what you're waiting for is price to take this level out, but not take it out on your TDI. And that will insinuate that a divergence is occurring, right? You can see price is still not even out of your water, right? So you're waiting to see if it's gonna take out the 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 what you call the peak or not, right? So let's see if price starts to show intent of going lower. So what can you do here? You can enter the trade once you can see that there might be selling pressure coming in. So you could actually enter the trade right here. Once you see this red candle, you can target obviously these double lows. This will be a great level for you to target, which would be a 1-to-1, or you can target the complete previous swing, or you can use your TDI as an exit, right? But another way to enter is to wait for this green line to cross with the red line, which would be your blood in the water. This red line is your blood in the water, and you're waiting for a cross. You could enter that way too, whichever way makes you feel more comfortable. So what happened when price crossed with the red line? This candle was formed. So with that candle, if you were using the indicator to strictly enter the trade, your stop loss would have been right above the candle that forced the cross, and you would have already had your 2.5 to 1, right? But either way, even the initial entry that you had was fine. And again, you could always wait for, after this candle closes red, you can wait for a retracement on this candle and find an entry somewhere here. So there's a few ways. So here we have another example. As you can see, this peak was formed, and on the TDI, it was a shark fin out of the water, which is set our high. So when price came back, and even though, as you can see, it wicked through it, which would still be considered higher than the previous swing, on the TDI, it was way lower. So what does this indicate? The fact that on the TDI, it was way lower than the initial shark fin in the water, which is our swing point, that just shows there's weakness in price. So once you see a red candle, you can get in a trade right here and catch the small scalp, or for a lower probability trade, you can wait for price to retest those levels and then come back. And always check your TDI. Make sure that your fin is protected. And you can see it all over the charts, right? So as you can see, this peak right here was shark fin out of the water. So price came out of the water and came back in. This is it right here, and it stayed protected. This area was protected until it eventually broke structure. It had a few bounces on it. So these fins outside of the range extremes, which is the water right here, are extremely important. So when they do form and they get broken in price action, but not in on TDI, that's a huge clue that a stop hunt is occurring. It's a trick the market makers use to trick you out of your position. So let me explain this one more time just for the overview's sake. So you have your swing right here. There is liquidity over this swing. So this is your swing. So you want price to come and take this liquidity, and you want to anticipate the entire move. So let's say price wants to take your liquidity, comes right here, takes it. You want to anticipate this move, right? So how you anticipate it is, as this is occurring, as the swing right here got broken through, and you can see a peak being formed higher than the previous one on the TDI, which would, let's say right here, this is your TDI. So this is your TDI. You have your water right here, which is the blue lines, and then you have your green line. So your green line right here came out. Matter of fact, let's make a green line. So you have your green line right here. It came up, formed a peak, which is a shark fin outside of the water. And this fin right here is this peak right here. So, but when it comes back up again, it doesn't reach and it reverses. But when you look at on price action, it completely took out the previous swing. But on the TDI, this swing is lower than this one. So as you can see, it's lower. But on your price action, it's higher. This is an indication that a stop hunt is occurring. So let's get into our compression based entry. So, what is a compression? A compression is a sideways accumulation. So, it's an accumulation with a direction, basically. A regular consolidation is just sideways, right? But when you have a consolidation that moves to a direction, which you see a lot of retail traders, they try to channel it and try to wedge trade it and they wait for a breakout, or I'm not sure how they do it, but this is what you call a compression, right? It's a sideways movement of a consolidation. So what occurs here? When this is occurring, institutions, I mean, are putting orders in, putting orders in, putting orders in. So there's a lot of money in this accumulation. And a lot of times this compression moves from price extremes to price extremes. So again, if you watched any of my previous videos, you already know what that means. It means going from premium to discount, retail to wholesale. That's the basis of a compression, right? And you can see it forming right here. So you have a micro compression right here, then price drop, then comes back to market extreme, which would be our premium right here, then comes back, breaks structure right here, comes back again to our premium, same thing right here. Then the market continues, and even here you have another small compression here, and even if you go on the 15-second time frame, there's a small compression here. So it's movement towards a direction, but not like a full-on expansion. It's a small increment of moves going up and down, going up and down, basically, or orders getting absorbed and prices using its extreme. So you can see here, prices using its extreme, using its extreme, right? And how would you trade this scenario, right? How would you use this to your advantage? For a simple explanation, you would wait for price to prove itself. So you would see a swing right here and price would break structure, and you would wait for price to come to an extreme, which would be the top quarter of your range. So if this is your range, you pull out your fib and you get the top quarter. The top quarter would be your premium level right here, and you more than likely will have an inefficiency here, which would be an order block. And you wait for price to move. So once price moves and breaks this level, and breaks this resistance right here and comes back into this new range, you can say, okay, now I can anticipate a compression. So what you would do, you would mark out your premium level again and get in a entry right here, right? So you wouldn't get an entry here because price hasn't proved itself. But once price proved itself once and reacted from a level extreme already once, you wait for it to break the range and come back into the range so you can get in a trade right here. And let's go into in-chart example. So here is an example of a compression, right? So you had price react from this order block, right? So this would be price reacting from a range extreme. So what you would do, you would wait for a price to do what? Break this level. So this level. Why this level? Because this was the range. And I explained ranges 100 times on my website and on YouTube, right? So this is our range. Price broke our range and came back into the range. So now if price heads to what? The market extreme, then that would be a compression. So your entry would be, first of all, you want to pull out your fib and check the range extreme, right? So your range extreme is down here, and can you see a inefficiency? You can see a order block. So this would be your entry. Why? Because a part of the compression cycle. The compression cycle is this coming back here, coming back here. This would be your compression, right? And as you can see, there is micro compressions within a compression. So here you had a break, price came back and broke right here. You had another compression, peak, price broke this level, came back here, but failed right here. That's why you don't want to look at the 15-second or the 10-second time frame. The lowest you want to go, in my opinion, is 1 minute, right? So here you have your reaction, and this would have been your entry. But let me show you something else. And this is actually, I'm going to make a whole bonus lesson on this, and I'll put it on my website. I'll probably include it in, I'll update, since I want to update the entry mastery course. So, yeah, I'll probably just add this lesson, but let me cover this real quick. So, as far as compression goes, compression doesn't only have to be at an extreme rate, right? So this is obviously an extreme rate. Why? Because price reacted from a range extreme right here. As you can see, it reacted from a discount. So we would expect the next reaction to be from discount. But sometimes, right, there's certain types of compressions where, look here, this was the range, price broke the range and came back, and it reacts close or at your 50%. So once price breaks and reacts from this level and breaks structure again, you would pull out your fib and you would focus again on the 50% or nearby. So as you seen, the previous level where price broke and reacted from was the area close to the 50% right here. And here, after it broke structure again and came back, it came to the same part. It came to the same decimal point. Obviously, I don't use specific decimal points. I just break it into four and use the area nearby, right? So in this instant, I would say price reacted from this order block that was near or at fair price. But look, even the range that initiated the compression, right? What did it react of? It reacted of the order block that was close or in your fair price, which is the middle. Your fair price is the middle of the range. So you have your premium right here, you have your discount right here, and middle is fair price. So as you can see, it's a mirroring effect, and I will make a whole hour lesson on this on the website because I figured this is something that I should include. But to keep things easy, just for right now, focus on range extremes, right? As you can see, price reacted from the extreme, broke structure again, and came back into the previous range. So you would expect the reaction from what? The price extreme. So this is my favorite entry when it comes to scalping. This is what you call last point of resistance. So at a higher time frame, you would see a stop hunt, right? So you would, let's say this is your 15-minute or your 1 hour, and you're seeing a stop hunt. So how to assure that this is a valid stop hunt? On the lower time frames, what you would see, and this could happen inside of the stop hunt, or it can happen below. It can happen either way. It can happen above the range or inside the range, external or external. You would see what you would see the stop hunt occur. So this is obviously your stop hunt, this entire thing, and then you would see a compression, right? Not a compression, an accumulation, right? And this accumulation would be your last point of resistance. Why? Because this is where you can see in real time institutions putting their last orders to push price down. Of course, you need your bias. Like any other entry, you need to make sure that you have the correct bias. But what you would see is you would see the stop hunt. So let's say this is the lower time frames, this is the lower time frames, and this was your high, right? This was your high, and price is approaching your high in your lower time frames, and you could see price will stop on this level, form an accumulation, and this accumulation, and once this accumulation breaks, you can get in a sell, or you can wait for a stop hunt inside of the stop hunt, like I explained earlier, right? And you can see it here. This was our swing where the liquidity was, price came and stop hunted. But how can you know that this was a stop hunt for sure, right? And this is how I would look at it. As the stop hunt is occurring, so this is the stop hunt. As the stop hunt occurred, price broke down and formed an accumulation right here. As price formed this accumulation, anything lower than this you can get in the sell once this accumulation breaks. But instead, price went up and then came down, then formed another accumulation. And once this accumulation broke, you can get in the sell once price break and put your stop loss right above, right? And there is another method, as you guys can see. There is a big accumulation occurring while the stop hunt is occurring, but this is more this is this is what I would say is more of a Wyckoff approach, and I will explain this in my next few lessons. And the thing with This would entering in Wyckoff, it would kind of be outside of the scalping realm just for the fact that your stop loss would be a little bit too big for scalping. It would be more of a 8 to 12 pip range. And when scalping, we're looking at a 4 to 6 stop hunt range. So, stop loss range. That's why I didn't include this in our lesson. But basically what the last point of resistance is that last accumulation where you can see in real time that orders are being injected because they know that they want to go short. They're just holding price and adding a few orders, but they can't just put sell orders right away. These sell orders need to be matched with buy orders, but these buy orders can be of less value than the sell orders, because let's say they put in sell orders right away, price would just dump and the price would never consolidate or go up. It would just go in a straight line. Why? Because the sell orders would overpower it. It needs to be matched with a buy order to form a micro consolidation on a small level before pushing price down. And as price goes down, they're selling, 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 and price continue dropping lower, as you can see here. So let's go in an in chart example. So here you have your swing, which built the liquidity. So what you're looking for a stop hunt. But as a scalper, you're trying to catch this stop hunt at its peak. And doing that, you want to minimize your risk and increase your reward. That's your job as a scalper. Again, scalping is completely different from day trading. A lot of my previous lessons are day trading. Here we're talking about strictly scalping. And you want to catch a reversal right here. How would you do that? You would go in your lower time frame. So I would go in my 1 minute and I would look for my last point of resistance, which would be my clear consolidation. Again, it can't be a almost a consolidation or it looks like a consolidation. It has to be a clear consolidation. So as we can see on the 1 hour time frame, and you can go in the 15-minute too. Price broke this level and closed above, which would be our first clue. Now what we want? We want a complete breakdown, right? And even as you can see, price previously did wick below this level and kind of based, but again, this is a kind of base. Same with here. This is kind of. Again, it's not that bad because price did stay in one area, so you could say this is a consolidation, but that's not clear enough to trade without having a lot of trials and error, right? You want to minimize, even though you're a scalper and you're trying to enter the market on a frequent basis, you still want to take the best chances. Don't just shoot for the sake of shooting. Take the best shots. Take the shots when you're not guarded, right? So what we're looking for is a clear consolidation. What is a clear consolidation? A rejection from both levels, right? So what do we have here, right? We have, if this was our range, this was our high, this was our low, this is a clear rejection from both levels, right? Price came here, wicked, and did not close, and price came up here, wicked, and did not close. That means price found rejection where? At both levels, right here. This is a clear consolidation, right? So what you would do is, for your entry, of course, you would want to be in line with your bias. I know I said this a million times now. You would see the lowest point of the consolidation, your highest point, and this would be your risk, which would be 5 pips. And your reward could be the last significant swing, which has two peaks around it, or you can take a shorter exit, right? You can take an exit at this level of liquidity if you so choose, or you could take partials after breaking the 50% of the entire range, right? Somewhere around here, somewhere around here. And what you want is you want to enter the trade once price breaks this level. Once price pokes its way out, you want to use that momentum to continue price down. Why? Because this is your last point of resistance. This is where the institutions are accumulating. And sometimes you would be wrong. But when you are wrong, your loss is small. But when you're right, your reward is big. And that's the point of trading. It's a numbers game, right? You could have your stop loss here, or if you want to be a little bit safer, you can have it somewhere close to the peak. I wouldn't advise you to have it all the way right here because this just wouldn't be smart. Your risk would be huge. And at the same time, if price does reach any level of extreme here, right? So you have your high and you have your lowest low at your last point of resistance. If price reaches this level of extreme, in my opinion, it will more than likely continue the opposite direction. You might as well get in a buy right here if price reaches this level, right? So what you could do is keep it at the 50%. That would be your best option. And look how funny this is. The fact that your 50% is in line with your compression. And it does make sense. If price gets above this compression, it's more than likely to continue above. So here for our last entry type, right? And this is super aggressive. I mean, extremely aggressive, because the amount of, if you was to choose to trade using this entry specifically, you can trade 5, 6 times a day, right? Across all pairs. But it's extremely dangerous. I mean, extremely dangerous. And your strike rate would be low, but then again, you'll be frequently in the market. So if you can protect your capital as far as the stop loss goes, you should be fine, right? And what you are looking for here is simply an engulf, right? You're looking for, let's say this is a red candle. This is a red candle. And I'm not going to do anything fancy as far as explaining this, because this is just simple. This is trading for dummies 101, right? So you have your red candle here, and this would be its wick, right? What you would want the green candle to completely engulf it, right? So you have a complete engulf. So once the green candle completely engulfs the red candle, what you would look for to go on the lower time frames and for price to retrace in this level, and either use the first lower time frame order block, which would be somewhere right here, to react, or use the last order block to react. And here you have two entries. You'll have two entries per candle. One could be right, one could be wrong, and we will cover, as we go into the next segment, we'll cover how to collect data on which specific one we use. And I really emphasize this because this is an extremely dangerous way of trading, because it's extremely aggressive. Because think about how many times a green candle engulfs a red candle on, or a red candle engulfs a green one, right? It happens plenty of times. Each pair, like it can happen 6 times, 6 times in one day in one pair across all your pairs, right? So you would be literally just trading the entire day. And this is why this is something I'm just sharing. I'm not advising you to do this unless you fully do your homework on this. And I'll show you how to do your homework, how to collect data on it. But again, it's simple. It's an engulf. So let's say this is a green candle right here. You would wait for a red candle to completely engulf it, right? And once this new candle starts to open, and we're talking about the higher time frame, obviously, once price starts retracing inside of this 1 hour candle, you would look for the first 1 minute order block, which would be somewhere here, and the last 1 minute order block. Then you would try and take a trade from here, or you try and take from here. Again, preferably you would want your the higher time frame bias. But in this instant, the higher time frame that you would want to use as far as bias should be your 4 hour or your daily, just for the simple fact that your underlying time frame here is the 1 hour already. So it's not like you are trading on the super lower time frames, then you're kind of building your way up. No, here you're starting off on the 1 hour, then you're dropping down. So you need to make sure your higher time frame than the 1 hour is in line, which preferably should be, you should look at the 4 hour or the 8 hour in this instant, just to kind of gauge the order flow from there. But in the next segment right here, we're going to cover how can you collect data on like an aggressive entry like this, and how can you take out the bugs out of it. So let's play out a few set of candles and take out the bias out of it completely. So we're not going to use the bias. We're just going to see the percentage flat, right? We're going to look at our aggressive entry without using our bias, right? And let's see what is price action more likely to use. And I'm using this example to show you guys how to take all the information that I'm showing you and start to nitpick it, right? See what works for you, what doesn't, what works best, and write it down. Preferably take screenshots of everything and write your statistics down. A lot of times, all you need to do is sample size everything 100 times, right? And then from there, you can kind of come out with an average. But the market does fluctuate. So I would say if you are practicing in your backtesting software, you could do the 100 trade sample size, but do it 3 times over the year in 3 different periods, because the market obviously has seasonal tendencies and it will change. So you want to try it out in the first quarter of the year, and then somewhere in the middle, and then in the last quarter of the year, to really see what's up with your strategy, right? But let's go on. Okay, so we have a engulf. We have a engulf right here. Why engulf? Because the candle body closed above the wick, right? So then we would go on our 1 minute and we would see what is the first OB and what is the last. We have our first one right here. And what we're looking for here is a 2 to 1 minimum, right? We want to look for 2 to 1 because your 1 to 1, a lot of times, as you get better of a trader, your 1 to 1, that's when you move your stop loss really to break even. So we're not going to count that in our data collection, right? So this we're looking at a bounce either from here or from here, and start collecting your data. See which one do you want to use, both of them. I mean, as in my opinion, as a scalper, as a pure scalper, you could afford to use both entries. But the way I personally trade and the way I found efficient is to pick one, to stick to one. I like, and that's my personality. I like doing the same thing over and over again. I don't like a lot of changes. I like going to the same places every time. I like driving the same car every time. I like going to the same gym every time. Everything stays consistent. That's why I prefer to stick to one. But this is how you come to a conclusion. Which specific entry would you use, right? So we had a reaction. Okay, now we had a reaction. We had a solid what? So we had a 2 to 1. So we can count this one. It was actually a 2.5, which is not bad. Did the hourly candle close? It's gonna close in 6 minutes. 1, 2, 3, 4, 5, 6. Okay, now the hourly candle closed. So let's go. Let's find another engulf, right? Almost, but it really didn't. Okay, we had a engulf. How? It was a green candle that was overtaken by the red one. So now we go on the 1 minute. And remember, guys, of course, the bias will make all the difference in the world. Right now, we're just collecting data. Because when it comes to a bias, you can increase your win rate by easily by 15 to 20% by just being in the correct order flow, right? So first OB, second OB. There's a really advanced way into entering this too, which would be a bounce from zone. So it would be, let's say, it will reach a point, then go somewhere. But we're gonna cover this another time. I'll probably post it on my website. Okay, so price completely blew through the first one, and look at the second one. And we had a so far we had a 3.5 to 1. So that's good. That's good. Let's see. Oh, it probably end up around 6 to 1. Okay. So let's go to the next setup. This setup did all right. Let's wait for another engulf. Oh my God, missed it. Okay, so we have a engulf right here. Let's go into 1 minute. And what do we have here? We have a OB right here. And on the extremes, we don't even have a OB here, to be honest. So we could probably just use the range extreme right here, somewhere here, even though this OB got used up a few times, but that's fine. Okay, so price did react off your OB. The only problem here is something That's really tricky, right? What you want to look for. The fact that this candle reached your OB at the end of the 1 hour candle. So this last candle was 5:59 and this candle 6 o'clock. We're working off the hour previous to that. So this would be invalid, right? So be completely invalid. More than likely not work. Wow, it still work. Interesting. But we wouldn't count that because even though it worked once, long term, you'll struggle with this. Let's wait for another engulf. Oh my God. I keep missing all these engulfs, right? Okay, so we have a engulf right here, order block formed. Let's highlight. We have our lowest OB right here, and we have our first B right here. Okay, we have a reaction. Why am I putting my stop loss here? Because this is the last swing, so you would expect liquidity to be formed right here. And price needs to come back and take this. Price would stop you out to then later on proceed. So you could have your stop loss a little bit wider. You could go 4 or 5 pips under your OB, or even maybe like somewhere like, let's say 3 pips under, something like that. Let's look for another setup. Okay, we have a engulf. What is the first OB? It's an OB right here. And again, I'm not using this OB because it's not inside our higher time frame 1 hour OB, right? If it was, then I would have used it, but this would be the first. This one right here, 1 second. This one right here would be the first order block that's in our higher time frame order block. Okay, price went too far. It's more than likely not coming back to revisit this OB. Okay, let's look for another setup. Okay, you have the engulf right here. What are we looking for? We are looking for the highest OB, which is right here, and our first, which would be the first in the range. Okay, so it missed your order block by literally 1 pip, and it continued your way. So this is how you collect your data as far as entry. So before picking the entry that you want to use for your trading career, you want to make sure you collect enough data. So sample size, 100 trades over, let's say 8 pairs, 4 times or 3 times in a year, right? So go back, let's say right now we're in 2023, so go back to 2022 and backtest the first 2 months, see 100 trades over there, and then go somewhere around April, do 100 trades from April to, let's say, June or July, and then do the end of the year. So try and split it out into 3 quarters. 3 pieces, or you could even do quarters. You can do 4 quarters and have 100 sample sizes in 4 quarters, and that's how you develop as a trader. It's a lot more than just learning an entry and just doing it. You want to really put in the work, really collect your data. Okay, thank you guys for going through this course. Again, make sure you like, share, and subscribe. And if you made it to the end, just put in Super Scalper completed, right? Comment Super Scalper completed. I want to see how many people actually make it all the way to the end, who really has the dedication. And what I'm gonna do here is for the people that made it to the end, right? Because a lot of people lack attention span. They wouldn't be able to make it to the end. Once you make it to the end, comment Super Scalper completed, and I'll pick one person, right, out of all the people that do comment this, and I'll have a 2-hour free one-on-one session with them. So any question that they have, anything that I'll help them build a trading plan, anything that you want help with. My goal here is to help you, right? So make sure you comment Super Scalper completed and get in the raffle, and I'll pick one person and get on the call with them. All right, guys. Later.